Your trading journal isn't just a record of what happened. It's a mirror. And if you use it right, it shows you patterns you can't see in real time. You don't see yourself revenge trading in the moment. You feel justified. But when you review your journal at the end of the week and see that you took 6 trades after losses and 5 of them lost, the pattern becomes visible. That's what a journal does. It turns invisible psychology into visible data. And once you can see it, you can change it. Most traders track entries and exits, price in, price out, profit or loss. That's useful for strategy evaluation. But it tells you nothing about why you deviated from your plan, why you sized up on that trade, why you held past your stop. The what is in your broker statement. The why is in your psychology. And if you're not tracking emotional state alongside trades, you're missing the most important data. Here's what to track: your setup, entry, exit, risk, and reward. All the standard stuff. But also this: how did you feel before the trade? Confident, anxious, frustrated, bored? What was happening before? Did you just take a loss, miss a move? Been watching for hours with no setups? After the trade, what did you notice? Relief? Regret? Overconfidence? That context is the difference between a trade log and a psychology mirror. When you review weekly, you start seeing patterns. Your worst trades happen after you've been flat for 2 hours. Boredom leads to forcing trades. After 3 wins, you start sizing up. Overconfidence. Your losing streaks cluster after big wins. You get loose. These patterns don't show up in one trade. They emerge over time. And you can't see them in the moment because you're inside the pattern. The journal lets you step outside and look. Here's a framework. At the end of each day, spend 5 minutes reviewing. Not just the trades, the emotional context. Did I follow my plan? If not, where did I deviate and why? What emotional state led to that deviation? Write it down. Don't judge it. Name it. Then weekly, review all 5 days. Look for patterns, specific triggers that lead to bad decisions, emotional states that predict your best execution. The most common patterns traders find: revenge trading after losses. You take a loss and immediately look for the next trade to make it back. The journal shows this isn't strategy, it's emotion. FOMO after missing a move. You see a breakout happen without you and chase it late. Every time you do this, you lose. Overconfidence after wins. 3 good trades, and you start trading outside your setups. You think you're seeing more opportunities. You're just less disciplined. The journal shows you the pattern, and once you see the pattern, you can interrupt it. You notice you're about to take a trade after a loss. That's the trigger. You check your journal notes. Last 3 times I did this, I lost. You don't take the trade. That's accountability. You're not relying on willpower in the moment. You're relying on data you collected when you weren't emotional. The journal becomes your coach. Here's what this looks like practically. You have a bad day. 3 losses. You're frustrated. You see what looks like a setup. You're about to enter, but you check your journal first. You flip back 1 week. Last Tuesday, same situation. 3 losses, forced a 4th trade, lost again. The pattern is right there. You close the platform. Walk away. That's the journal working. Not because it stopped you from feeling frustrated, because it gave you data that overrode the emotional impulse. Your journal also tracks improvement, not just profitability. Psychological progress. You measure how often you follow your plan, not results. Execution. This week you followed your plan on 8 out of 10 trades. Last month it was 6 out of 10. That's progress. You're not measuring whether you made money. You're measuring whether you're becoming more consistent. That's what improves over time. Not your strategy, your ability to execute it. You already know most of what your journal will show you. You know you revenge trade. You know you chase. You know you size up when overconfident. But knowing it in theory and seeing it in data are different things. The journal takes vague awareness and makes it concrete. It shows you exactly how often the pattern happens, what triggers it, what it costs you. And that specificity creates change. You can't fix a vague problem. You can fix a pattern that happens every Tuesday after 2 losses. Your trading journal is your best psychology coach because it doesn't lie. It doesn't let you rationalize. It shows you what you did. And when you review it honestly, you see yourself clearly. The patterns, the triggers, the gaps between your plan and your execution. And once you see it, you can change it. Not through willpower, through awareness. You already know what to do. The journal helps you actually do it.